about it. When we talk about non-hindsight opportunity, everything's easier after it happens. But during the session, what could keep you off the wrong side and get you to pick a bottom or pick a top? This morning in this session, I talked about this, but I was on earlier the recording. I'll talk about it again, but live, we had a rally, okay? Super strong, especially when it goes through an iceberg that easy. But forget about that. It gets up to yesterday's high, the 41 area. So a lot of people are like, well, do you try to buy it through there? Do you try to sell it because it's going to be resistance? And you let the market tell you what the probabilities are. So if you look in here, it runs up, has a 500 lot pulse order that really doesn't drive it much higher at this point. This is all we know at this point, right? We know it's rallied a lot since the open, and we know it's like flagging sideways right now, trying to decide if it has enough buying to go up through this shaded area or selling to go down. And sometimes it doesn't know, right? It's like a basketball game. It really doesn't know who might win, but then all of a sudden the guy turns the ball over, the guy comes down, shoots the three, and makes it. And because of that sequence, it changed the outcome of the game in the next 2 minutes. Sometimes that happens in a market. It's not predetermined. The market knows it's going to open, go to 41, and then go down to 96. It takes interest in the psychology of it. And so when we fast forward this, the tell that the market was getting toppy was number one, this buy pulse that came in. Big buy order. Most people think buyers, go get it. Now you're wasting buying when you see it already come because it's filled. This isn't a buyer that's sitting on the sideline waiting to buy it. This is a buyer who already got filled. So he's done. He already, all right, I'm going to get edgy here. So if you're a offensive person, mute the mic or close your ears. But it's like no, I won't say it. I'll say it another time. We go, there's no way I could say it non-offensively. So I'll hold back. So you get 300 buy pulse that comes in, right? Bam, gets rejected. And some longs come in. That's just a head scratcher that the downside off of this rally could be the right side. That's all. So we do break down and we make one more attempt to pop. All right. One more attempt to pop. And that's even predictable when our laser starts going red. There's the pop. When you see that red, I'll back it up. When you see it get red right in here. All right. A little pop is coming. We don't know if it's a little pop, big pop. Is it going to make it through 41? It has the energy to do it. 2 sell orders come in. If it gets above these sell orders, it could go. But all these longs, these little Johnnies are looking for a blow through 41. Another sell pulse. It's like it gets above there, guys. You cannot be short. And then all of a sudden, we go sideways, and these become less relevant. It's just sideways. And then this 200 lot buy order. Is he going to get laughed at? If we get below him, yes. And you get some longs sideways, you go red, green, and then look at all this. Then when this sell order comes in, bam, it just gives markets the price to go where it wants to go. And then the longs continue to come in. Longs come in, they're wrong, they're sellers, and the market nosedives. So when that's like the anatomy of trying to find where a market might get toppy. And if you're long, get you to cover and take profit. If you're bearish and you're looking to fade it, a qualification for fading it. Because market profile, volume profile, that analysis doesn't tell you when. It might help you with where, maybe. It might help you with location, might help you with your opinion. But the when moment's the most important moment. And so if you had 41 as a level, maybe because it was yesterday's high, maybe it was because of some sort of profile level, maybe it was because you flipped a coin and 41, whatever. You still got to qualify it when it gets toppy. What are the symptoms? We're like good doctors because we're focused on, we're good doctors though. We're focused on we know the symptoms of because in medicine, there's all kinds of diseases and illnesses. In trading, it's up, down, or sideways, right? So is it going, it's a bullish, bearish, or can be drifty and choppy. So we're just looking for those two things. And the symptoms of it are other people's positions, the interaction between buy orders and price. And it doesn't get much more complex than that. The complexity comes from the rabbit holes people go down trying to predict this price. And it all comes back down to the simple. Too many people long, too many sellers, probability going down. Inside information, if you think about market timing and you think about people that in Congress aren't lucky, they just got information before most of the rest of the world does. All right. And so the edge comes in knowing stuff before most of the rest of the investors do. That's maybe trading stocks or anything else. So information, if you can't get that, which most can't, you're going to have to find stock trap traders. You're going to have to see the herd about to fall over the cliff, because it's the being greedy when everybody's fearful, being fearful when everyone's greedy. And it's knowing when to fade, knowing when to hop on the trend on pullbacks, knowing when breakouts are going to happen. Staying off the wrong side is even more important than getting on the right side, right? It's that first step. Saving money is like making money. Managing your risk, but having some detail of what risk management is instead of just 2% of your account or some generalities that really aren't easy to execute. You got to know where you're going to get out before you got to get in. That's one of the first things I learned. Know where you're going to get out before you get in. Second trade first. What does second trade first mean? Just that. If I buy it to get long, where am I going to sell it to get out before I bought it to get long? Think about that. And that's what's important. So it's an extended highlight today, just going how to figure when a high is a high. And then we'll take this thing down and say, focus on when's a low, right? And the first time that we had this market to have two things happen. We had a sell pulse that quickly got rejected. That's this pink box right here. Watch how quickly it gets rejected. I'll play it in real time. So the market comes in, longs puke, shorts come in, and then wham, right there, that pink box is a big sell order. It went up. Selling makes it go up. That's not supposed to happen. So that's just the head scratch that there could be a bottom down here. And you see my arrow jump on here in real time, showing people this. And then sure enough, the market starts to accumulate too many shorts, too many buyers, too many buyers. That's what you need for price to go up. So you're either in our group or on our charts. Get with it.